Let me go ahead and welcome Commissioner Caroline Crenshaw and Gina Gale Fletcher to the stage. It is such an honor to have both of them kicking off our day. I will make the introductions quite brief because we want to make sure that we get to substance. Normally, I would start with accolades and background, but I think Commissioner Crenshaw is familiar to many people here for the incredible fight that she has been engaging in and the meaningful work that she has done through her years at the SEC, even before she became commissioner, and now in that role as commissioner. Let me briefly say, though, for anybody who hasn't been paying close attention, during these times, one of the most powerful tools that we have is our voice. Many people right now are afraid to use that voice for fear of the repercussions. Anybody who didn't notice this week, Commissioner Crenshaw actually issued 3 separate official statements and gave a wonderful speech. And through these statements, she's helping to draw attention to the dangers associated with the way her fellow commissioners are currently exercising their authority. She was able to explain in very plain terms, for example, what it means for ordinary investors and for smaller investors when mandatory arbitration suddenly is welcomed in as a way of helping to resolve a broader set of disputes. She also did a really great job dealing with the legal difficulties that come around when you see gamesmanship being used and an abuse of the administrative process where rules that have been formally adopted don't actually come into effect, requiring critical disclosure because of continual delays. And she's able to articulate in very clear terms why that is being done and why it matters and why we should all be worried. So I could not be more grateful, and I can imagine a better way to start our day. And we have the benefit of having her here, joined by Professor Gina Gale Fletcher, who's one of my many favorite people in the field, along with everybody else here. She's a professor at law at Duke Law School. She's also currently the Associate Dean for Intellectual Life. She's played a whole variety of roles, including serving on the SEC's Investment Advisor Committee. So let me go ahead and welcome them both to the stage.
Good morning. Can you hear me? All right. Thank you, Kate, for that incredibly kind and probably most thoughtful introduction I've had in 5 years at the SEC. It's not just my bio. So that was incredibly nice. Thank you. And based on what you just said, I just want to give a major thank you to my team. We're a small team, and we've, in addition to today's talk, issued 4 statements, I think, just this week, plus done all of our enforcement meetings, and it just keeps coming. So thank you to my team. All right. Thank you also to Better Markets for the invitation to speak with you all today. I do have to make the standard disclaimer. These things still matter, I guess. But before I begin, I do have to make the standard disclaimer that the views I express today are my own and do not necessarily represent the views of the SEC or my fellow commissioners. And while there's been a lot of breathless coverage of crypto lately, I'm going to turn our attention to a different topic: private market access. American capital markets appeal to the investors the world over because of their depth, liquidity, and the stability created by well-crafted, conscientious, and reliable regulation. Underlying this complex ecosystem is the separation between public and private markets and the regulations that draw those boundaries. That separation is deliberate, time-honored, and intended to reflect real, important differences between public and private investment opportunities and the nature of the underlying issuers. While the United States can proudly claim, for now, the gold standard of financial markets across the globe, Germany's Autobahn system is equally renowned as a feat of infrastructure. Of course, the Autobahn is famous for its general lack of speed limit. But much like the separation between the public and private financial markets in the US, the Autobahn is a distinct network, separate and apart from other roads. Like private markets in the US, the Autobahn is available to those with a higher risk appetite. But it's not open to just anyone with any vehicle, and it's actually carefully regulated and monitored. To drive on the Autobahn, cars must be able to meet a minimum speed requirement. Obviously, mopeds and bicycles aren't allowed. And the specific safety rules are diligently enforced by a specialized highway patrol. There are also segments of the Autobahn that do have speed limits, and certain vehicles, like trucks, have lower speed limits. It's also significantly more difficult and more expensive to get a driver's license in Germany than in the United States. So while the Autobahn may sound like an unregulated public racetrack open for joyriding at will, it's anything but. And it is an intentionally separate experience from driving, say, on the streets of Berlin. As calls for retail investor access to private markets accelerate, I am concerned that we are headed for a high-speed collision, with Main Street retail investors left without airbags. First, I worry that we're recklessly blurring the important separation between our public and private markets. Second, I'm concerned that this push for private market access is done without regard to the risks and the current performance of those markets relative to the public markets. Finally, I fear that we have failed to right-size our regulatory approach to private markets in recent decades. As a result, we are now increasingly exposing retail investors to dangerously bloated risks that they and regulators are not prepared to face. The divide between our public and private markets reflects one of the most basic principles of securities regulation. Access to broader public markets requires more disclosure to investors and more oversight by regulators. This is true for operating companies as well as investment funds. We know from almost a century of regulation since the Great Depression that this balance of more disclosure for more access to public markets and retail investors works. Data have shown that more expensive disclosure requirements in equity markets, more extensive disclosure requirements in equity markets, coupled with strong securities regulation and stricter enforcement mechanisms, actually lower the cost of capital for investors. In recent years, conversations about increasing access to private markets sometimes include expressions of alarm about the decline of the IPO market since the 1990s and early 2000s. It seems some of the talk of decline may be hyperbolic. The data actually show an ebb and flow over time, and in fact, we saw a record-breaking 20-year high in the number of IPOs in 2021. Either way, the topic of IPO activity inevitably leads to perturbations about increases in regulatory burdens for public companies. But a closer inspection of the private markets ecosystem suggests that there are other reasons why operating companies and funds have concluded that private markets are the right environment for their business. In fact, some argue that deregulation in the private markets has encouraged capital to skirt the public markets and its required transparency. Others note that market forces independent of regulation, such as increased M&A activity and greater availability of private capital, are the true cause of this shift. And yet, a lag in the IPO market is often used as evidence that growth opportunities for investors are far more plentiful in the private markets, where retail investor access is limited. But lagging IPO numbers are an odd justification for pushing even more capital into the private markets. If we're concerned about declines in public market participation, I doubt that driving more investors into private markets is the answer. Instead, perhaps these developments should prompt us to revisit the equilibrium between public and private markets. It's clear that the reason private markets are more attractive than public markets is, at least in part, that we have not adequately adapted our regulatory regime to address the private markets as they have grown to exist today. And the proof is in the numbers. Regulation D private placements have increased from $588 billion in 2009 to roughly $2.15 trillion in 2024. And gross reported assets under management for the SEC reporting private funds has increased from $8 trillion in the first quarter of 2013 to $24.3 trillion in the third quarter of 2024. I've spoken before about my concern that private markets were meant to be the exception to the transparency that is the hallmark of our public markets. Like the Autobahn, they were intended to serve as a separate infrastructure for operating companies, funds, and investors who meet certain criteria and who are prepared for heightened risk and reduced transparency. But now, we are taking the wheel and steering investors of all stripes into private markets as fast as we can. And regulators have been instructed to consider ways to facilitate access to private markets for American investors, in particular, retirees. Meanwhile, the SEC has already taken steps to open private markets further by, one, abandoning staff positions which limited the exposure of closed-end funds. Let me try that one more time. Abandoning staff positions which limited the exposure closed-end funds have to private investments, and at the same time, expanding existing relief that allows certain closed-end funds and business development companies to co-invest alongside affiliated private funds. There also may be upcoming changes to the definition of accredited investor and qualified purchaser to increase direct access to the private markets by retail investors and further disrupt and distort the public-private divide. Amid all of this hype and momentum, it's worth pumping the brakes and asking, why now? Current market conditions make me deeply skeptical of calls to democratize access to private markets and forsake the public-private divide without the addition of corresponding protections for retail investors. Comments touting the need for broader market access spin a story to retail investors that they're missing out on windfall investment opportunities in the private market, financial FOMO, if you will. They hear that the securities laws and our rules are all that's standing between them and guaranteed wealth and security in the land of milk and honey. The sales pitch for this illusion comes at a time when many Americans are desperate for a sliver of economic hope. Inflation persists, the labor market has slowed, and ongoing market volatility is unsettling. But pitching private markets as the key to financial security and prosperity perhaps only dangles false hope. First, the uncomfortable truth about this sudden push for greater retail access to private markets may be not that we are opening the gates because of investor demand, but rather there is excess supply because many of the usual sources of private market capital are drying up. In fact, recent data show a sector-wide contraction in private equity representing a 7-year low point in capital raising by private equity firms. And the stock prices of major private equity firms are struggling despite the promise of imminent exposure to retail investors' pockets. Private credit is also suffering from decreased borrower interest after several years of explosive growth. Indeed, some of the most highly sophisticated private investors, public pension funds, are paring back their private credit investments due to concerns about looser underwriting standards and rising credit risks. If these developments are concerning to large institutional investors, they should certainly be worrisome for small retail investors as well. Second, there's good reason to doubt the promise of mammoth returns. Recent data show that private markets have actually underperformed large-cap U.S. stocks on a 1, 3, and 5-year basis. Even in the more promising market conditions, retail funds with exposure to private investments come with higher fees and expenses that eat into any potential returns for investors. The race for retail exposure to notoriously high-cost private markets is especially puzzling, since many traditional retail funds offer incredibly low or even zero expense ratios. Third, there's also significant risk that retail investors would get access only to investments that more sophisticated investors have already turned down. The reality that retail investors will likely be served only leftover private investments for higher fees than traditional retail investment raises the specter that retail investors may be taken for a ride. All of this is to say, retail investors' retirement savings will be used to prop up wobbling private markets purely to save private firms hungry for more capital and to benefit asset managers eager to collect the exorbitant fees. But at what cost to retail investors? At what cost to the economy? At what cost to the country? But putting that aside, let's assume for the moment that there may be some performance upside for retail investors in funds with private market exposure. That sounds great, until a retail investor wants to get off the Audubon. The assumption by by those pushing for increased access to private markets is that retail investors buy and hold for decades when they invest in long-term for retirement. So the decreased liquidity in private markets investments won't be an issue. In reality, retail investor behavior isn't that simple. What about retirement account rollovers as investors change employers over time? What about non-retirement retail investment? What if investors need quick access to their money for any number of reasons, like job loss, buying a house, or large unexpected expenses? We have already had a glimpse of what happens when liquidity in a private fund screeches to a halt. In one recent example, investors nervous about rising interest rates, flocked to redeem only to find that the fund had limited redemptions and continued to limit them for over a year. Now imagine that type of turmoil on a much larger scale, beyond just the wealthy investors in one private fund. The potential liquidity mismatch between retail investors and private investment duration may cause significant harm, not only to the individual investor, but on a more systemic basis in times of stress. All of these efforts blur the lines between our public and private markets, and there will be consequences. So you'd assume that the SEC is acting as the responsible highway patrol and ensuring that there are appropriate investor protections in place as we direct retail traffic. And surely, the SEC is also keeping a watchful eye on the systemic risk implications of these fundamental changes, right? Unfortunately, this expansion of private markets is coming at the same time the Commission has backed away from the prospect of meaningful oversight of private markets. In the discussions about expanding retail access to private markets, it's curious and concerning that I haven't heard much about the need for corresponding expansions in oversight. Interestingly, in recent days, I've noticed some new talk about the need for guardrails from proponents of retail access to private markets. I certainly agree. But I'll admit, I'm a little confused because some of those same voices actively opposed a prior Commission's effort to actually install those same guardrails. We cannot just give lip service to the importance of those protections. And we can't use the promise of some hypothetical future protections as an excuse to let retail investors ride into 100-mile-per-hour traffic today. After all, as we've discussed, the reasons that the private markets are allowed to function with less oversight and less transparency than the public markets is precisely because they are not available to Main Street investors. This specific point is fresh on our minds, given the private fund advisor rules that were adopted by the Commission in 2023. The rules would have enhanced the regulation of private fund advisors in several important ways, including by requiring quarterly statements, annual audits, and would have restricted certain activities with disclosure-based exceptions. The principal challenge that opponents to the rules raised was that Congress intended to draw a sharp line between the private funds and funds that serve retail investors. And petitioners argued that the rules crossed that line. And ultimately, the rules were vacated by the Fifth Circuit. But where is that enthusiasm for that same sharp line now that private funds want retail investor money? Apparently, to some, the public-private markets divide should exist only when it's being used to resist regulatory oversight. In facilitating retail access to private funds, it seems that this Commission has conveniently forgotten the basis of the court's ruling. If we now intend to allow retail investors to be exposed to private funds, that change fundamentally alters the nature of those funds under the federal securities laws. It's worth asking whether that change would empower the Commission to more directly regulate those funds, as we sought to do with the private fund advisors rules. The import of our public and private markets divide should be clear. If you let retail investors onto the Audubon, there must be a highway patrol. With retail access to private markets, one might also reasonably expect more focus on systemic risk issues posed by the expansion of those markets. Currently, the Commission monitors for systemic risk posed by certain private funds by reviewing data submitted confidentially on Form PF, or Form Private Fund. In 2024, the Commission adopted amendments to the form that would enhance the quality of the data filed on the form. Opening up private markets to retail investors in the manner currently contemplated would fundamentally change how those markets function. This seismic shift creates the real possibility of increased systemic risk to our entire financial system. Yet, at this exact same moment, the Commission is actively preventing those improvements to Form PF from coming online. Just 2 days ago, the Commission voted to extend the compliance date of the amendments to Form PF for a third time. This latest extension is for 1 year and all but explicitly admits that it's not really an extension at all. It's a backdoor rescission of those amendments. The amendments have been extended so many times that the extension is effectively indefinite, and the Commission is currently exploring other ways to reconsider the form in its entirety. I question the legality of these repeated extensions, and I am equally troubled that we are hamstringing the Commission's ability to monitor for systemic risk at the same time we expand access to the private markets. To be sure, it's an interesting time for the Commission to decline better data on systemic risks in the private markets. In past crises, we have learned the hard way that distress in private funds can have catastrophic ripple effects throughout our markets. Better data about private fund strategies would help us identify those risks as they come down the road and respond with potentially evasive maneuvers in the event of an approaching crisis. Today, there are a multitude of risks in the private markets worthy of our attention, including private credit's interconnectedness with banks and insurers, and the concentration of private fund assets in only a few large managers. These risks, among others, warrant a watchful eye, and that's just the risks the private markets present before we introduce the added complexity of retail investor access. The Commission seems dead set on ignoring even the possibility of systemic risk in private markets, and we do so at our own and retail investors' peril. So buckle up. It seems that we are all about to merge into some high-speed traffic. Of course, this doesn't have to be a white-knuckle ride. There are actions the Commission could take to impose meaningful safeguards and oversight of the private markets, safeguards that are long overdue. I've already shared my ideas for reforms to the Regulation D offering framework in detail before. I won't bore you with that today. The Commission has already offered prudent enhancements to Form PF, if we ever stop extending the compliance date. And we've previously considered reasonable regulation of private fund advisors. And these are just the ideas that we've already contemplated. We must take the time to seriously consider additional measures to tackle notorious valuation issues, require important disclosure to investors, and manage rampant conflicts of interest. If we want to explore adjustments to the long-standing public-private markets divide, we must do so with caution, and we must be prepared to offer corresponding protections to investors. After all, despite its high speeds and increased risks, the Audubon is safe because it is far from lawless. Thank you.
I think we're supposed to sit in the chair and have a conversation.
Come this way.
Is this
Perfect.
okay? All right, we'll get close. Yes. Hi, how are you?
I'm fine. How are you?
I'm doing well, thank you. Thank you so much for your comments just now on the private markets. I admit to having heard some of them yesterday at the Investor Advisory Committee meeting, and I was grateful for your comments then. So I want to kind of stick with the theme that you have brought to us here today, because I think that even though there's been this breathlessness, as you said, about crypto going on, it's actually a part of the same theme, right? This retail access to the private markets. And so one of the things I want to ask you about is, well, if you could start from scratch. So let's say we don't have this system that we have now, but we do have Ralston Purina, which, you know, I kind of like. But if you could start from scratch, Caroline, and you wanted to, Commissioner Crenshaw, I apologize. And you wanted to create, think about this public-private divide and take that seriously based on what the 33 and the 34 Act have to say about how you get public money, how you get to raise capital from the public. What would that look like for you?
With Ralston Purina?
You can keep Ralston Purina or you cannot. I'll give that to you.
I think Ralston Purina and his progeny are actually quite well thought out. Essentially, Ralston Purina and its progeny, in the Fifth Circuit, incidentally,
Yes,
actually talk about if you are going to offer money to private investors, they have to be sophisticated. That's what this is all about. Or do you have the sophistication and the ability to bring that sophistication to bear on what your investment is? You can have you can take a test, right? We've said, oh, we should let everyone in now because you can just take a test. Someone will administer a test and you can get in. We have folks saying, oh, well, they've taught themselves economics, they've taught themselves about securities law. Fine, that's all great. But if there is no information on which to base that sophistication, we have achieved nothing, and we have not actually followed what the structure of Ralston Purina and its progeny have laid out for us. So maybe, the standard we have now maybe isn't the right one. The accredited investor test based on a monetary amount. Yeah. Maybe that's not the right one. But where it really comes down to is there sufficient information to bring any level of sophistication to bear? Yeah. And we have gotten rid of all of that information. So I do think there's an important place for the private markets. But I think if we were looking at this sort of based on just that case and its progeny, you would have different levels of disclosure. And you would have sort of an on-ramp to, you wouldn't just have nothing with Reg D, where you have to file a form sometimes. And you would actually have sort of either a layered concept where investors can get the information. You can have all sorts of different types of disclosure for different sizes, but then you have to really think about what is the right size and what is actually small. We seem to think everything is small. Yes, and that's something to worry about with I think moving forward too. Everything is small, so everything deserves exceptions. At that point, we've just swallowed the whole rule. So I think a much more sort of layered disclosure where you're really balancing what information is available with who can access the investment and make sure that they actually can bring their sophistication to bear.
I think that's important, right? Because one of the things that sometimes gets forgotten as we try not to think about Ralston Purina is that the court did say that disclosure was necessary as a part of that sophistication. And it also said a small number of investors. And we've gone so far away from this idea of a small number of investors for private markets that really, as you said, everybody can kind of get in by some means or another.
Yep. And I worry about small businesses in this too. I think this was meant for small businesses. Reg D in the 1980s was really designed to be an exception to help small businesses, not everybody. It's not meant to just, hey, everyone, if you can get access to this capital, go forth. And I think small businesses are hurt by this because I think the capital is flowing to places that don't actually need it. And the small businesses are actually getting left behind.
Yeah. So how would you then respond or think about responding to folks who try to make this more a conversation about investor choice, right? And about retail investors needing to have some choice and being able to diversify their investment options to be able to access the private market. So how do we think about this investor choice line of argument that always comes up as we think about retail access to the private markets?
It's interesting. Choice seems to only apply in this context. If you want to choose to go to a court, too bad. You now have to go to arbitration. If you want to choose to have climate disclosures, too bad. They're not allowed. If you want to choose to have political spending disclosures, nope, can't do it. So it's not really a discussion about choice, right? Because investors have asked for political spending disclosures. Investors have asked for climate disclosures. Investors could have gone to arbitration before if they really wanted. That's always been an option to them. This isn't about a private market solution. Investors have had the ability to go to arbitration if they so chose. But now they don't get an option. They don't get a choice. They must go to arbitration if companies choose to put this in their governing documents. So it's only choice when it comes to retail access to private markets. That's where we actually care about choice.
So, so one of the as this conversation about giving retail investors better access or more access to private markets is part of a much larger onslaught, right? Of trying to, in my opinion, weaken the public markets and weaken securities laws in order to allow for certain moneyed interests to be able to get access to retail, really retirement assets. They want 401k access. And tokenization, I think, is a part of this conversation as well. So how do we, for those who may not really kind of see, right, that how that freight train is coming, as we talk about tokenization and we talk about private markets, and it might seem like we're talking about two different things. Can you help us kind of see how these two things might be connected and really be part of this bigger conversation of trying to get access to retirement retail money?
Yeah, that's a good question. I think no one actually sort of seems to me to be speaking on the same page about tokenization. What actually is tokenization? And what are we talking about when we're talking about tokenization? If we're actually talking about just putting issuers on a blockchain, maybe that's innovative. Maybe that gets us something. Maybe that improves market efficiency. But it doesn't change anything, or it shouldn't, right? The securities laws should apply. But the worrisome piece of this is tokenizing securities, or what were securities, or other types of assets, and eviscerating the securities laws in their entirety, with the idea that, you know, we have to allow for innovation and this freedom of choice. And again, innovation is great. If we want to think about ways to use, digital ledger technology and blockchain to improve clearance systems, certainly there's potential for improvements there, and maybe the technology does the job. But I think we want to be very careful about using sort of innovation, or the idea that this has to be innovation, as a way to get around all of our securities laws, and just tokenize everything, as the Commission has put out all sorts of statements saying various types of digital assets are not securities. And so the worry is you sort of shift into that world, so anyone has access, and you have essentially no guardrails.
Yep. I'm going to turn it to questions from the audience. I can continue talking with Commissioner Crenshaw, but if there are questions from the audience, we have a mic back there, and so we can take a couple questions if you have questions. We have a question right here on the edge.
Hi, thank you. One question is about intermediation in these markets. Who's a retail investor and how are they investing? So what happens when it's an ETF, it's another fund? How do you then do accreditation?
Yeah, so it's a good question. That is another problem with sort of this shift, right? 40 Act open-end funds have sort of been a generally plain vanilla, but with the introduction of Rule 6C11 in 2018, I think it was, we have all these unintended consequences of what these funds now look like. And you have all these levered funds and these single stock funds. And, these are another avenues of expansion. It was one of the reasons I was worried about the crypto ETPs, the spot ETP market that we approved. And I worried that just sort of opened the doors to the market to proliferate. So it's a big problem.
We had a question back here.
Thanks. I was monitoring the SEC's Investor Advisory Committee meeting yesterday, and Ms. Fletcher, you made a comment about how the exception is overtaking the rule. And I was just sort of curious if you two could talk about how we might remedy that and what are the downsides of the exception becoming the rule.
You're the commissioner.
Yep, but you, I think we both made a similar point.
Yes.
I mean, well, Regulation D is really, you can raise basically unlimited capital. In theory, you're supposed to have 35 unaccredited investors,
yeah.
and then the rest are accredited investors. But there is so much capital available, and you have to file you're supposed to, I'll say that, file a form with the SEC. There's actually an Inspector General report out from, I can't remember what year. I can get you the year, but a lot of folks don't even file the form.
And there's no consequence for not.
And there's no consequence. We've never brought an enforcement action for not filing the form. Maybe we did. Anyway.
Yeah, but it's not routine.
Yeah, it's not routine.
It's not routine. Is what I mean.
But so you can raise as much money. And so what's the incentive to ever go public? You don't have to have, in the private markets, you can raise as much money as you ever could. In the public markets, you don't have to have shareholders. You don't have to disclose anything to the Securities and Exchange Commission. The only sort of thing keeping, I think, companies for still going public is liquidity, secondary market liquidity, which as a private company you may not have as much for your own employees, and that's under attack too. There's often sort of folks talking about increasing the liquidity in secondary markets for private assets, and so you can raise all this money. You don't have to have any of the downsides, and so why would you ever go public? So with that exception, I think it has swallowed the rule. And I think that's where you have to start thinking about ways to add more of that information that investors need, to go back to Ralston Purina, to add information to actually fulfill our obligations, to allow investors to bring their sophistication to bear and think through what the information should be to have access to that type of offering. But I'll let you add.
Yes, I agree completely with what Commissioner Crenshaw has to say. I think we have time for one more question right up here up front. If this timer is correct, I'm going to go with the timer. Okay.
Thank you. I very much appreciated your presentations, both of them actually. And I obviously agree, but I have to say, look, in an internet age, I think restrictions to sophisticated investors are a very tough sell. And you're going to just forever run into folks who think they have read somebody's posts, which in many cases we now know for sure are being paid for. And it's a big problem. And in that sense, I think the tactics of this need some rethinking, because this is going to be irresistible, like a lot of other funny technological arguments that are made, like this is just the greatest thing since sliced bread. It's much low cost, high security, blah, blah, blah. But in an internet age, this is a very tough sell.
I mean, I think that's why we have to have the filings to the SEC. I think you need a backstop of information that's used by analysts, that's used by brokers, that's used by folks other than the internet bots and the internet folks on Reddit. And if you have that backstop of information, what the company is actually doing, who the ownership structure is, what their financials actually look like. If you have that backstop, and even if you have internet stuff, then you can help bring enforcement cases. Then you can say this is not accurate. Is it going to be perfect? No. But then you at least have a world where the folks who know how to get the information, the analysts, the structure of the market can operate in the way it's supposed to.
So let me say thank you so much for coming. And more importantly, we can't thank you enough for your public service. I know nowadays public officials are under attack, criticized, and there's a propaganda machine out there about that. What people don't know is that public service is not all that glamorous. It's a ton of work. The staff kill themselves. I know. We talk to them. We read it. You have done an unbelievable service to the American people, not only in your votes, but in your statements and being clear, talking in English to the American people about things that are vitally important to all Americans, which is our economy and our capital markets and whether people have jobs and whether they can invest and have safe retirements. And so your tireless work is not gone unnoticed, and it's greatly appreciated. And thank you for coming today.
Thank you. My pleasure.